Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 456 of our YouTube channel and podcast. And I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today is Stock Market Monday, and so we have another day of talking about markets, talking about what is going on, and honestly, not a lot of positive things have been going on in the stock market as of late. So we're going to talk about what's going on, talk about how you should feel about it or how you may currently feel about it, and then talk about what we should do on the back end. So don't get too pessimistic. Watch this before you do anything too rash. And for sure, we will do our best to help you make the best financial decisions possible moving forward in your investing life, even amidst a market correction. So stick around for a discussion of all that and more in today's episode. Before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for everybody who's watching or listening to this show on a day-to-day basis. Now, I think lately in the market, we have seen really two things dominate the news. And the two things that have dominated the news by and large have been the fact that the market has been dropping pretty precipitously, number one, which is going to be the primary of what I'm talking about today. And then two, Elon Musk's purchase of Twitter, which has been agreed to, at least at this point, and everything going on there. I'm not going to beat the dead horse of talking about Elon Musk and Twitter anymore. It's a big deal. A lot of stuff going on, taking a huge social media company private. But I think I have an obligation to you all who watch or listen to the show every single day to talk about what's going on as far as the market correction. Because we are in the midst of a market correction, and we're in the midst of something that many would argue is far more like a bear market than a market correction. So what I want to do today is just take you through this idea of market corrections, take you through what's been going on as of late, what may be driving the market further down, and then just what we may look for in the future. Ultimately, we know that, if you've listened or watched the show for any period of time, that I am a long-term guy. I'm a long-term investor. I am not looking for short-term trends or to be a short-term trader, but it's interesting to understand what's going on and to make sure we are in the right frame of mind to make the best long-term investment decisions that we absolutely can. So let's just jump right into it, right? Year to date now on the S&P 500, as of Friday's close, we are down 13.86%. 13.86%. And then the Nasdaq on a year-to-date basis, down 22.09%. So statistically, the Nasdaq is in bear market territory. So being down 20% or more from highs. The S&P isn't technically there, though many S&P stocks are in their own bear market territory. They are down 20% or much more. Now, there were a lot of tech earnings this past week, some very good, some not so good, right? Amazon didn't live up to expectations and their stock got crushed for it. Apple didn't seem to have any big issues out of Apple, even though on Friday they did have a pretty bad day. But for the week last week, Apple was only down 2%. And I believe the market itself, let me see, I think the market itself was also down around the same amount. Yeah, the Apple and the market were down about the exact same amount this past week. So it just kind of followed the market. But there were other companies that did quite well. Meta had a great week as far as their stock. And if you don't know what Meta is, just think Facebook, right? Facebook last week was up 9.7%. So that's just a big week for a big stock. But nonetheless, the market was down nearly 3% this past week, and it's just added to the carnage that is the market as of now. And so as an investor, it gets kind of dicey, right? Because most of this year has been negative, right? If you look at a chart of the S&P 500 this year, you see from January 3rd, the first trading day after the new year, from January 3rd to January 27th, the market was down 9.8%, right? So a lot of our loss had already happened to that point. Then from January 27th to February 9th, the market was up 6%, right? So gained some back. And then from February 9th to February 23rd, market was down nearly 8% there. From February 23rd to March 29th, so a little over a month there, the market was up 9.6%, right? So a lot of oscillation going on. But since March 29th, so the month of April, what have we seen? We've seen a pretty dismal market. So if I go to the close March 31st to the close Friday, April 29th, it was down 8.8%. Or if you go from the close April 1st to the close April 29th, it was down 9.11% for the month, right? So a really, really bad month in April, and one of the worst that we've seen in a long, long time. And it has pushed us into this correction territory. And correction is just semantics, and so is bear market, right? These words, these phrases are just semantics. They're just things that we say to characterize what is going on in the stock market at a given time. But it is important to note that what we are going through is not new, right? What we are going through is not abnormal, right? There's so many headwinds and so many things going on in the economy, right? You can talk about inflation. You can talk about expected interest rate hikes by the Fed, right? You can talk about the fact that this past week we got a GDP reading that for the first quarter, GDP was, it grew at a negative rate. So it contracted by 1.4%, right? And typically we call a recession 2 consecutive quarters of said contracting economy, right? So that was negative. Still got a bunch of supply shortages. You've got Russia, Ukraine still going on. You got high oil prices still. So just a lot of things that can push against the market that can be headwinds. Now, if you know anything about the stock market, though, you know that the market itself is a forward-looking measure, right? The market is taking future cash flows, what they expect future cash flows to be, and discounting those cash flows back to today, right? So once the market has reacted to something, that something may not have even happened yet. All right, that's why with the Fed, a lot of times the Fed likes to let the market know what course it's going to be on without saying too much, right? They want to tell the market, okay, we expect to do this moving forward, so the market can go ahead and price that in, and there aren't these big swings based on what the Fed chooses to do. But nonetheless, right, if we just go back, right, and we say, since 1974, November of 1974, how many times has the stock market been in correction territory? So how many times has the market been down 10% or more? And that answer is 24 times. 24 times since 1974, right? So 1974 that's what, 48 years? So a little less than 48 years if we're talking about November, but nonetheless, in 48 years, to have 24 corrections. So on average, one every 2 years, and we still freak out about them, right? And if you look at the recent past, it's kind of been like one every 2 years, even though it seems like we've been through a whole lot more because of coronavirus and things like that. We really haven't. So all of the corrections, there were several in the 70s, from 74 to 79. Let's see, there was one in 74, 75, 76, one in 78, 79, 80, 2 and 80, right? So within just a 6-year time period, there were 7 corrections, and one of those corrections was into bear market territory. The market was down more than 20% in November of 1980, right? Then we saw one in 83. There was one in 87, which we know got very, very bad. 87, October of 87 still has the worst single day in stock market history. Then January and July of 1990, there were corrections. 1997, 1998, 99. There was a bear market in 2000. 2002, there was a correction. 2007, so we had a big gap there from '02 to '07 where there was no correction. And then obviously '07, we get the financial crisis, which is the worst of the bear markets that we see here. We end up seeing 5 bear markets since 1974, right? Then we get in April 2010, we have another correction, 2011, 2 in 2015, so a few years there. A few years later, there were 2 in 2018. And then in 2020, obviously, we had the coronavirus crash. Market was down more than 30%. So we saw a bear market there. And now we have another correction, right? Now we have another correction that has come into our lives. Now, is this something that we need to be actively worrying about? Well, I just told you that this happens all the time. Right now, the headwinds may be different, right? And everybody wants to convince themselves that it's different this time, that it's not just the same old stuff. And truly, the catalysts may not be the exact same, but the idea is the exact same. The idea is that investor sentiment turns negative for one reason or another, right? Market sentiment turns negative because either, let's say, corporations aren't, making earnings. Let's say there's big macroeconomic factors, whatever it may ultimately be. And investors sell, right? Institutions sell, individuals sell, and the market drops. And when they sell more than they buy, prices drop, and ultimately you end up with a correction or maybe even a bear market. And it's not comfortable, right? It's not something that we invest through and it's just all, hunky-dory, but at the same time, it is necessary. It is a necessary condition if you're going to build wealth over a long period of time that you must invest through corrections and through bear markets. You must do it, right? Because the attempt to try to time a correction or to try to time a bear market is futile. It's a futile attempt. You absolutely cannot do it with any reasonable amount of success, right? What ultimately happens to most people who try to time recessions or time bear markets or time corrections is that they end up getting out of the market far too early and then getting back in far too late. And so they miss out on a lot of gains. Or they just convince themselves that the market is always going to be going down, which if you know anything about the market, again, you just pull up a chart of the S&P 500 over the past, 40 years, right? Here, Google will take me back to May of 1982, right? And it's just an up to the right, it's got kind of the parabolic curve to it. Because that's the way your money grows. That's the way compound interest works. Yes, there are some bumps along the way, right? There's, the tech bubble. There's the financial crisis. There's coronavirus. That's just a quick V spike. And then right now we're on a downward trend even now. So we can look at this and just go, over long periods of time, you make money, right? Over long periods of time, you will continue to grow your money. Now, is it comfortable to look at a 1-year chart of the S&P 500? So if you go back a year, you go back to the beginning of May in 2021, the market's down 1.45% in a year. And we're just not used to that, right? Because even with that 1.45% negative for the past year, the market's still up 72.21% over the past 5 years. Right? So what, 70%, you divide that out by 5, that's 14% per year. I know that's not compounded or whatever, but let's just say on average 14% a year, and you had 1 year that was negative 1%, right? So it's pretty amazing what the market has yielded in the recent past. And so to look at the market currently and go, why is this happening? This is unfair. This is not realistic. Is wrong, right? It is very realistic that the market pulls back. It's very realistic that the economy doesn't just continue to expand in a perpetual state, or that companies don't continue to grow at this crazy high perpetual rate that they've grown at in the recent past. That's not to say that companies won't continue to grow. That's not to say that the stock market won't continue to thrive over the long term. But it's to say in the short term, it's very, very possible that the stock market could see some pain. Now, there's this article from January 25th of this year, and this was, let's see, January 25th. Let's see what was going on, how far down we were from the highs. Okay, we closed January 25th down 9.18% from our open for the year. So down 9.18% for year to date. And at that time, somebody at Charles Schwab put together this nice little article and put together some graphics that talks about bear markets and bull markets, right? And what they look like and what can be expected, right? So the whole idea is that bear markets have been shorter than bull markets, and bear markets have not been as dramatic as bull markets have been, right? We feel like they're dramatic because they're on the news and everybody's talking about them, and it hurts far more to see the value of your money go down than it feels good to watch it go up, right? Because we expect it to go up. But they show here that the average duration of a bull market is 2,069 days. 2,069 days, right? That's a long time to have any type of positive or negative trend going on, right? For something to be going on 2,069 days. And if you just divide that out by 365, we're looking at 5.67 years is the average duration of a bull market. But the average bear market only lasts 446 days. And I've seen estimates that are far lower than that. But even so, we're talking about just a bit over a year, right? And they're probably talking here from the beginning of the downtrend to the point when we get back above where we were to begin with. And so there are differing definitions of what a bear market looks like. But the average return of those bear markets is negative 38.4%, right? Compared with 209.2% being the average return for a bull market. So bull markets last longer and provide higher returns to the upside by multiple times over than the bear market does to the downside, right? So what am I saying? What's all this matter, right? All this means is that don't freak out, okay? Keep buying, keep putting money to work, right? Just think about it this way. I know many of you who probably listen to this or watch this haven't invested for long periods of time. Look, admittedly, myself, this is the third correction I have invested through. So I was investing in September of 2018. I was investing in February of 2020, and I'm investing now, right? So it's the third correction that I have invested through, and none of them have been comfortable, but I've kept putting money to work in every single one. And guess what? Your returns look quite great if you're putting money to work at low values, right? On the back end, right? While it's happening, everything looks negative. Everything looks horrible. Down 13% or whatever, it looks horrible, right? But if you're putting money in, in February of 2020, March of 2020, and the stock market's down 30%, I mean, on the back side of that, you've seen some pretty fantastic returns. If you just go back, if you put money in at the bottom, even being down 13% year to date currently, if you put money in at the bottom of the coronavirus crash, you're looking at a 79.27% return from that time, right? And if you go from the high just a month prior, you would only be up 22% from that time, right? So a very dramatic increase in your returns by just buying lower prices. And that's why I say that dollar cost averaging and simply just buying with every paycheck is so valuable, because you're going to buy highs and you're going to buy as the market's going up, and you're going to take that momentum and ride it. And when the market's down, guess what? You get to buy as well. Just for instance, the month of April just ended. A bunch of people are getting paid at the end of the month of April. And guess what that means? That means a bunch of 401k contributions are also being made at the end of April, beginning of May. And guess what? You're getting to buy at discounted prices. Why in the world is the stock, and this baffles me all the time, why is the stock market the only place that we hate buying something at a discount? Why is the stock market the only place where something can be on sale or decrease in price and we don't want to buy it when it decreases in price, or it hurts to buy it when it decreases in price? Anywhere else in our life, right? A pair of shoes, clothes, electronics, anything, right? If it decreases in price, it increases the likelihood that you will go purchase it, right? But for some reason, the stock market is not that way. We get so emotionally tied to the positivity that when the negative occurs, we get pushed away and we don't like it. But ultimately, if you can grin and bear it and continue to buy and maybe even put a little extra money to work, if you've got some extra money that can be invested, by all means do so, and you will reap benefits on the backside. Now, is that to say that we're done with this correction? No. Is that to say that this correction doesn't become a full-blown, 20% plus down on the S&P bear market? No, that's not what that means either, right? But what this does mean is that even if you buy at 13% down, at no point has it ever been a bad idea to buy 13% below market highs, right? So let's just, I'll try to give you an example here. If we can go back to the coronavirus pandemic and just see if I can pinpoint around where the market was at certain points during the pandemic. So let me see. The market was down 12.6% between February 12th, 2020 and February 28th, 2020, right? 12.6%, right? And the market would continue down another 20% from its highs from that particular point, right? So it can continue downward. So even if the market continued down to be 33% down, and then you just continued out of it. Let's say the market did the same thing on the backside of a big crash here as it did back then. You would be up 40% if you were buying when the market was down 13% at that particular point. And now the market's down 13%. And if you can make 40% in the matter of a couple of years, that's fantastic upside. Those are fantastic returns. I don't know anybody who would turn those returns down in their portfolio. So just keep in mind, it is not a bad idea to buy. If anything, it is a better idea to buy than it was a few days ago, right? When the market was a little bit higher. It's a better idea to buy than it was at the end of March when the market was, considerably higher than it is today. I mean, for the year, we were only down 3.44% at the end of March. Now we're down 13.86. So, the moral of the story is keep buying. The moral of the story is keep putting money to work. If you're a young investor, stop playing around with Tesla and stop playing around with, meme stocks and stop playing around with NFTs and cryptos and things like that, and put your money in index funds and continue to put money in over long periods of time. And you will be glad that you did. Look, I'm not somebody who's going to say that you should, never do any type of speculation. That's not my game. I believe small amounts of people's portfolios can be speculative assets. But I think so many young people got into this market when it was hot, right? And got into speculative assets and got burned, right? Which is what always happens. Anybody who stays in speculative assets too long and thinks that the music's never going to end, the music always ends, right? There are so many stocks that have just been obliterated from where they were at their highs. I mean, I've talked about some of them before, but let's just go to some of the most obvious names, right? Peloton down 81.68% in a year, right? Netflix wasn't even a name that was, super hot or anything. It's a big company, down 62.61% over the past year. Zoom, right? You look at a 1-year chart of Zoom, down 68.28%. I mean, I can go on and on. Let's see. I think another one, maybe Shopify 1 year down 61.96%, right? All of these were in the hot speculative type of market, and they have been absolutely crushed on the back end. And a lot of people messed around with Tesla, right? Tesla's up 27% over the past year, but from its all-time highs, I mean, it's still down in its own bear market territory, right? So nonetheless, I'm not saying that there should be no speculation ever. I'm not saying that it's not fun to speculate, because I'm sure, it is, especially when things are hot. But ultimately, what's going to be most beneficial? What's going to be most beneficial is just continuous buying over long periods of time, buying market corrections, buying bear markets, buying when things are good, buying when things are bad, right? And just having a very consistent strategy. So ultimately, these are the things I think you should do, right? Just a couple things. One, have a plan. Okay, know what you're doing and why you're doing it, right? If you're a college student and you're somebody who is, putting money into Robinhood, to invest during the pandemic because that's what was hot and that's what was cool, that's not a plan, right? Have a plan. There's probably better uses of your money if you're a college student, okay? So have a plan, work the plan how you're going to invest and why you are investing. Most of the time, if you write down why you're investing, you can talk yourself out of bad decisions and into very good ones. Review your risk tolerance, right? Understand what your risk-taking ability is and should be. Because if you take more risk than you should, market downturns like this are going to hurt even more. If you take the proper amount of risk, then a market downturn like this should turn into a fairly good buying opportunity for you in your portfolio. So understand your risk tolerance, your risk profile, and then take advantage of these types of opportunities because of that. Rebalance if you need to, right? So many people got so stock heavy over the past few years, given the amazing returns. And then you get really stock heavy, you stay really stock heavy, and then what happens? What happens? You get a market downturn, a correction, a bear market, and the value of your portfolio decreases mightily, and your risk tolerance was not in line with what your asset allocation was, right? So rebalance in order to stay within the bounds of your risk tolerance, and just take your life and your stage in life into consideration. Understand where you are and where you should be, and you will be fine, right? Understand yourself and make good decisions on the back end. Now, real quick, before we close out, I don't want you to think that the stock market is the only thing that's been destroyed this year, right? If you owned just a bond index, like a total bond market index, you're down in correction territory or very close this year as well. The Vanguard Total Bond Market Index is down 9.49% year to date. And if you go a 1-year chart of that particular bond index, down 10.52%, right? So a lot of asset classes are getting beat down, but that is the time when putting money to work, even as painful as it may be, is the best idea, right? So keep putting money to work, keep doing your best to be a smart long-term investor, and you will thank yourself for it later. You may even thank me for talking you off the ledge today later on, but nonetheless, I'm not just trying to talk you off the ledge, but I'm trying to encourage you to continue, encourage you to push forward and to be the best investor, the best manager of your own finances that you ultimately can be. So hopefully this is helpful to you guys. You can understand corrections and bear markets a little better. Hopefully it wasn't too negative of a sentiment on this episode. Hopefully it was a bit more encouraging and just informative to you guys. And hopefully you can take this and you can apply it to your own life and your own situation and make your portfolio as effective as it can be for you and where you are in your own life. So thanks for watching this video. If you could, go down below, hit the big red subscribe button, like this episode. Leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. That's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.